high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in ASFBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we explore the story behind key banking sector developments. It is the 14th of December 2023. I'm Nazia Iqbal, and this is what we have lined up for you today. First up, our cover story will discuss what the government's extra spending means for the bond market. In bankers' view, Uma Shankar Paliwal, the CEO of the Small Finance Bank Association of India, talks about the journey of small finance banks and more. In Banking for You, we will tell you what peer-to-peer lending is. In the Expert Takes segment, our consulting editor, Tamal Bandyopadhyay, talks about why RBI Governor Das is playing like Rahul Dravid on the monetary policy pitch. And at the end of the show, we will share the results of last week's poll and the question for this week. All this in today's edition of the Business Standard Banking Show. In what can be seen as a sign of fiscal prudence, the Finance Ministry limited its additional spending to 1.29 trillion rupees. But what will this mean for the bond market, especially if the government takes that route to bridge the gap in funding? Kasturi Akhil finds out.
In the first batch of supplementary demand for grants, the Union government last week sought Parliament's approval to spend a net additional 58,000 crore rupees, over and above the budgeted amount, out of the gross additional spend of 1.29 trillion rupees for the current financial year. According to papers tabled in the Lok Sabha by Minister of State for Finance Pankaj Chaudhary, the additional cash outgo is primarily meant for funds for the Employment Guarantee Scheme Manrega, fertilizers and fuel subsidies. Despite the demand for additional expenditure, the move is not seen as having a significant impact on government bonds. Typically, a rise in government borrowing through bonds leads to a fall in bond prices and a rise in yields. According to media reports, the bond market was expecting a much higher amount than the 58,000 crore rupees announced later in view of the forthcoming general elections. However, market participants believe that since the government is committed this time to achieving the fiscal deficit target of 5.9% for the fiscal year 2024, it is less likely to increase its borrowing through government bonds, preventing any significant drop in bond prices. The government aims to borrow 6.55 trillion rupees in the second half of FY24, accounting for 42% of the projected gross market borrowing of 15.43 trillion rupees for the entire year. So far, the centre has maintained it will comfortably meet the ongoing financial year's fiscal deficit target by means of higher tax and non-tax revenues, including dividends from the Reserve Bank of India and state-run banks.
I think that there are offsets and cushions in place, including the higher tax collections, both direct and indirect, where we could see some overshooting from the budget estimates. In addition, we have seen a higher, RBI dividend this year, and the expectation is that with the performance of the PSUs, the dividends from the PSUs will also be slightly higher, perhaps from the budgeted amount. And therefore, with these cushions in place, I think that the government will be able to achieve its fiscal deficit target for FY24, and consequently, we are not expecting any additional borrowings or additional supply of bonds in the market by the centre.
Last month, the Department of Economic Affairs Secretary Ajay Seth said that the centre is confident of achieving its FY24 fiscal deficit target of 5.9% and was committed to lowering the fiscal deficit to 4.5% of GDP by FY 2026. According to experts, the Indian economy has witnessed robust tax collection this year, which will help offset the net expenditure of 58,000 crore rupees of the gross additional spend of 1.29 trillion rupees. Further, the balance of over 70,000 crore rupees would be taken care of by means of the savings of ministries and departments or by enhanced receipts and thus help meet the fiscal deficit target in due course of time. On 30th November, data released by the Controller General of Accounts showed that the central government's gross tax collection in the October-April period of the current financial year rose 14% on year to 18.35 trillion rupees. The buoyancy in the tax collection is largely driven by direct taxes, with income tax mop-up showing 31% year-on-year growth and corporate taxes growing at 17.4%. If not through the longer-dated government securities, does the market expect additional issuance of state government bonds to meet the supplementary demand for grants?
For states, they've seen a good traction in terms of their capex spending as well as revenue expenditures this year have been higher in terms of last year when we do a similar comparison. But there again, I think that there have been a lot of transfers from the center. The devolution has happened, periodically on time. We are not expecting any, fiscal slippage there as well. And while last year they under borrowed compared to what was the initial expectation, perhaps this year they will, borrow whatever has been announced.
The brief uptick in state government's borrowing in the December quarter got the market worried on the supply front. However, at last week's auction, the state raised 15,132 crore rupees, lower than the 26,350 crore rupees indicated in the borrowing calendar for the December quarter. During the October-December period, states aimed to issue bonds worth 2.37 trillion rupees, and experts believe even though the size of the auctions might vary, the aggregate supply of bonds in the quarter is not expected to overshoot the calendar amount. Therefore, any additional spending sought by the union government is not seen as having an impact on state government bonds either.
So, the bond market experts seem confident that there won't be any impact. What about the small finance banks or SFBs? It has been 8 years since SFBs came into being. My colleague Raghu Mohan had a chat with Uma Shankar Paliwal, the Chief Executive Officer of the SFB Association of India, about this and more. Here's the chat.
Welcome to the BS Banking Show, Mr. Paliwal. Good to have you.
Thank you, Mr. Raghu.
At the outset, your views on the SFB journey so far.
As you are aware, the RBI had granted the license in September 2015 to 10 SFBs and they started operating. So the requirement and the expectation, including the objective of the RBI, was that it should lead to greater financial inclusion and also serving the unbanked areas, including the rural and the semi-urban areas. So to that extent, yes, all the 10 SFBs have been in existence, have been doing a good job. And in addition to the 10 SFBs which were granted the license, 2 more have joined in the last 2 years because of the one converting from a cooperative bank, which RBI has also been encouraging. So it has been a great journey, I'll put it that way.
Is the SFB model sustainable in its current form?
Yes. Categorically, I can say that for the reason that what the expectation and the licensing conditions have been that 75% of the advances have to go to the priority sector. And all the SFBs have been doing it very successfully. Number 2, of the total advances, 50% have to be also below 25 lakhs. And that is also a condition which leads to a furthering of the financial inclusion. And the very fact that 25% of the branches have to be opened in unbanked areas have also been met. Number 2, I would also like to reiterate that the conditions in the market and the operations of the SFBs in meeting the requirements and also showcasing them as for the license conditions for which they were set up as credible institutions has been established in the last 7 years.
But do you think there needs to be a reroute to the priority sector norms to more or less align it what state-run banks have at 42% of lending?
Well, the licensing conditions, as we all know, were different. At the same time, yes, 75% of the priority sector advances can possibly, over a period of time, the regulator can think of having a glide path. May not be touching 40% because then the gap between the two and the distinction between a small finance banks and a universal bank would disappear, at least on this front. But yes, from 75%, review can be done over a period of time, indicating that the banks which have been there for a particular period and have served the need, and also because of the increase in the size of the balance sheet and the people which we have been able to serve, could be a glide path, say, of every 2 to 3 years can be thought of.
The stock market performance of SFBs appears to indicate that further supply of capital is going to be an issue. Your views on this?
Well, if you look at now, majority of our entities, the banks are listed. I'm talking of the 10 ones. The remaining 2 have been the recent entrants. So what we have seen is that there have been an overwhelming response in terms of the IPO participation by the general public as well as by the investors. So that itself proves that there is an appetite for the stock, there is an appetite for the sector, and this is also further complemented by the fact that on the TAP licenses, 10 applications have been received and which were under the active consideration, and some of them are still under the active consideration of the regulator, that is the Reserve Bank of India. So that shows that the way the SFBs were perceived, the way the stakeholders, including the shareholders in the capital market, are perceiving, are giving a good response, and that augurs well for the future requirements as and when they would be required by the sector.
Do you think there needs to be further clarity on the path to universal bank licenses for SFBs?
The guidelines of 2015 itself indicate that after the successful completion of 5 years and subject to the conditions which have to be met in terms of the net worth and the capital for applying for a universal bank license, the SFBs who are fulfilling that requirement are eligible. Now it is left to the SFBs to take a call as and when they feel like that whether it would be a requirement or an option for them is available. And yes, in case there is some clarity required on the existing guidelines, the SFBs, including the Association of Small Finance Banks, can always engage, and we are willing to provide the inputs to the regulator to ensure that there is clarity in case some need is felt on the part of the SFBs for doing so.
Mr. Paliwal, it was wonderful having you on the Banking Show. Have a good day.
Thank you, Mr. Raghu, and same to you. Thanks a lot.
After small ticket unsecured personal loans, the banking regulator has trained its sights on P2P or peer-to-peer lending. But what exactly is P2P lending? Rimjim Singh explains. Peer-to-peer or P2P lending is a mechanism which connects individuals in need of credit with others willing to lend. This practice cuts out the financial institution as the middleman. The P2P lending companies often offer their services online and more cheaply than traditional financial institutions. This helps lenders earn higher returns compared to savings and investment products offered by banks, while borrowers can borrow money at lower interest rates. The P2P lending websites connect borrowers to lenders. First, an investor opens an account with the site and deposits a sum of money to be disbursed in loans. The loan applicant posts a financial profile, which is then assigned a risk category that determines the interest rate the applicant will pay. The loan applicant can then review offers and accept one. The monthly payments and money transfers are handled through the platform. The process can be entirely automated, or lenders and borrowers can choose to haggle. In India, peer-to-peer lending is regulated by the Reserve Bank of India. In 2017, the RBI published a consultation paper on regulating P2P lending and the final guidelines were released. In 2016, there were around 30 peer-to-peer lending platforms in India. Even with a first mover advantage, many sites could not gain market share and grow their user base, possibly due to the reserved nature of the Indian investors or lack of awareness of this type of debt financing. However, P2P lending platforms in India are helping a huge section of borrowers who have been rejected or have failed to qualify for a loan from banks. As of August 31, 2019, as many as 19 companies have been granted licenses by the RBI. Peer-to-peer lending is riskier than a savings account or certificate of deposit, but the interest rates are much higher. This is because those who invest in a peer-to-peer lending site assume most of the risk that banks or other financial institutions normally assume. In 2022, the global peer-to-peer lending market was worth $134.35 billion. This figure is projected to reach $705.81 billion by 2030. The easiest way to invest in P2P lending is to make an account on a P2P lending site and lend money to borrowers. The sites allow the lender to choose the profile of their borrowers, so they can choose high risk or high returns or more modest returns. Many P2P lending sites are public companies, so one can also invest in them by buying their stock. In many countries, soliciting investments from the general public is considered illegal. Crowdsourcing arrangements in which people contribute money in exchange for potential profits are considered to be securities. Securities offered by the US peer-to-peer lenders are registered with and regulated by the Securities and Exchange Commission. In 2016, the New York State sent warning letters to 28 peer-to-peer lenders to obtain a license to operate unless they immediately complied with responses to demands to disclose their lending practices and products available in the state.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Well, last week we got to know what's on Mint Street's mind. RBI Governor Shaktikanta Das in particular didn't lower his guard, keeping the policy rate and stance unchanged. So why is he playing like Rahul Dravid on the monetary policy pitch? My colleague Swapnil Joklekar asked our banking expert Tamal Bandyopadhyay. Here's the conversation.
Hello and welcome to the show, Tamal.
Thank you.
Now, this week, you wrote how RBI Governor Shaktikanta Das plays like Rahul Dravid. And I guess what you're also saying is that Das is content dealing in singles as far as monetary policy is concerned. Why do you say so?
Thanks, Abnel. Yes, our governor is a cricket aficionado, if I may say so. At the Business Standard Program, BFSI program on October 31st, he asked the bankers to play like Rahul Dravid, play long term. And he himself plays like Rahul Dravid. That's what the point I am making. He teaches, or rather he preaches what he practices himself, But Rahul Dravid is a player is different from Rahul Dravid, the coach. Rahul Dravid, the player, played long term and pretty slow but steady. Whereas the coach blamed the pitch for India's loss at the World Cup finals. I'm talking about the recent final against Australia. Now, here is a gentleman, RBI governor I'm talking about. He plays like Rahul Dravid, even though he's a coach in that sense, RBI governor, but he plays like that. And so last policy was in a difficult time, relative term. This policy is in a better time. Growth is now catching up. And also inflation side, of course, food inflation is a problem. Last 2 months, inflation was going down. But he has not changed his stance. He has not hiked the rate because he knows that inflation genie is not yet bottled. And he is happy to keep the stance, and also even his approach to liquidity. Even though he is not as aggressive as he had been in October announcing Waymo, but this time he said that no, he'll keep a very hawk eye on liquidity, and it will be nimble-footed to do that. So, and he says that my objective, or the RBI objective, continues to be contain inflation at 4% till such time. Let's not talk about rate cut, etc. So, irrespective of the nature of the pitch, he does not let his guard down. He is ever cautious, if not as hawkish as he was in October.
Right. So it's a long game, and he's looking to take it deep, you're saying.
Absolutely.
And let's stay on the topic of RBI. Paytm stock last week fell almost 20% after the fintech company said it will lower its focus on the loans below rupees 50,000. This comes, of course, after the RBI directive on the same. Now, do you see this softening focus as the new normal?
Well, that's a semantics. We say new normal or normal, but the fact is this: the small ticket unsecured personal loans, which had been growing at a speed, which is difficult to maintain in the past 2 years, has to come down. And if you see that, there are a few interesting facts. One is this: the delinquency, the borrower's ability to pay back is suspect now for some segment, and it's going up. Second is this: many of these borrowers are over leveraged. They have taken more than one loans, maybe 3 or 4 loans. And third is this: many of these borrowers are not from our familiar cities and towns, which means this is a product which has been probably missold, if I may say so, quote unquote, to people who don't understand what they are doing. And other part is this: I have seen in terms of few lenders, they use a hook saying that, look, if you come and take the loan, you will get into this credit bureau database, and this is a sort of, we are formalizing your migration from informal to the formal sector.
Right. And so last week we also heard about the wage pact, the 17% hike that bankers are agreed to. Now, I have to ask you this: do you think there's a better way than this protracted pattern of talks that have to resume every few years?
Yeah, this is a 5-year pact, and typically it takes a few years. Then the bankers get the arrears at one go. I'm sure they are happy with getting the arrears, but why would they wait for so long? But my question is, why would there be an industry-wide wage pact? Because the bank A is different from bank B, and bank B is different from bank C. Now, in the past, there have been instances where a bank wanted to get out of the wage pact. For instance, Bank of Baroda, I know for sure it did, but it never happened. It is unfair. I think it's unfair to the people because, as I said, the different banks, different managements, even though all of them, particularly, we are talking about the public sector banks, the majority owner is the government, but again, to use the cricket analogy, they are playing on different pitches. Now, why would there be a similar wage increase for entire industry, while one bank is performing too well and one bank is not performing that? Now, you can always ask the question, why would the employees be penalized for the bank's performance? Because it's a senior management that drives a bank. But I don't agree with that. I think it's the entire composition of employees that drives a bank, and you should get out of the wage pact.
Right. So going solo may actually be in their best interest, is what you're saying.
Trade unions will hate to hear this. Trade union leaders.
But thank you so much for joining us, Tamal. We'll see you next week.
So Tamal believes that Das is playing the long game and that slowing growth of small ticket personal loans will be the new normal. Last week, we asked whether the central bank's actions made your personal loan more expensive. 79% of you said yes, while 21% said no. Also, the RBI said you can now pay up to 5 lakh rupees to hospitals and educational institutes via UPI. That's up from 1 lakh rupees earlier. But should the UPI limit be hiked for all transactions? That's this week's poll question. Should the RBI hike UPI limits for all transactions? Our poll is open from today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more banking news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in ASFBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.